Five, four, three, two, one. It's showtime. How's everybody doing tonight? You're welcome to the strategy room. You're here with the banker next door on this Friday night, April 11th, 2025. It has been quite the week, right? Been quite the week out there, quite the roller coaster ride in stock markets. It's pretty wild out there right now. So, well, I have the typical night tonight. I got lots of action-packed news stories. We're going to take a look at a lot of the economic indicators that came out this week. Inflation showing signs of perhaps coming down. Consumer sentiment, though, not looking so hot, but we're going to take a look at what's going on with the Treasury. We're going to look at what's going on with, how are different people feeling about the economy right now. We're going to take a look at some bond market things. We're going to look at a lot of charts and graphs tonight. And as usual, later in the show, I'll run through the 5 episodes that I have come out this week. I'm going to talk about the episodes that I have coming out over the next couple of weeks because I got some things going on, as you can imagine right now. I got a lot of family stuff with Easter coming up next weekend. So got some different things happening there. So I'll talk about that later on in the evening. But let's get rolling here. Off the bat, we're going to take a look at our Doge clock. I guess it would help if I shared this, right? There we go. Okay. So we're going to take a look at the Doge clock. How is the Doge going? Well, we've gone over 300 billion. That's fantastic. We've gone 306 billion to be exact, and we're now up to $2,731 of savings per taxpayer. So that is absolutely fantastic. Now, I would be remiss to mention that our lovely Congress passed the SAVE Act this week, as well as some the big, I guess, a beautiful bill, if you will. Now, they said they're going to cut $1.5 trillion, which sounds fantastic on the surface, right? Until you realize the key thing there, and that is that they said they were going to cut $1.5 trillion over 10 years. So it's actually a couple $100 billion every year that they're going to cut. Now, I ask you, when you look at this clock and you see this ginormous $2 trillion annual deficit sitting right here, and the fact that our deficit for the fiscal year is probably going to be well over that $2 trillion mark, what good does it do us to cut a measly $200 or $300 billion a year? Does that do anything? Did I miss something? Like that is that gets us basically nowhere. And it just goes to show you that what I have been saying for months is that Congress is not serious about cutting the spending. They're not serious about cutting the money. They're not serious about getting in there and basically telling some people that, sorry, you're not going to get money. You're not going to get a paycheck. You're not going to get funding for your stupid pet project. You're not going to get your pork. You're not going to get all this nonsense. They're just too afraid to go back and tell certain members that. They're too afraid to tell certain constituents that, sorry, the grift is over and the money tree is been cut down. They can't do that and don't want to do that. And I've been saying that for a while. You're going to have to basically grab them and force them kicking and screaming to make serious cuts to the budget. So, and obviously the bond market is going to react to that. And I think the bond market did react to that this week. I think the bond market looked at that and basically said, this is a joke. They try to put out this headline number. Oh, we're cutting $1.5 trillion, which now, if that was true, if that was for this fiscal year, then it's like, okay, now we're talking about something. But that, again, when you get then you have to go to the next line over the next 10 years. That it's absurd on its face. So like I said, Doge continues to make some progress here, and we'll see if they can continue doing it. Again, their target is that $1 trillion, but we'll see if they can get there. I think they're going to have to get in and start doing some a lot more serious and more aggressive cutting in a lot of these agencies if they're going to come anywhere near that $1 trillion mark. But we shall see. But let's go in. Okay, so obviously the big news of the week was the tariffs, right? We had the tariffs coming on, And then Trump decided to pull them back. Trump basically issued a 90-day pause on the widespread reciprocal tariffs that were out there. So, just hours after implementing tariffs on varying levels on trade partners worldwide, President Donald Trump said he would pause the reciprocal import taxes for 90 days. In a post on Truth Social, Trump said the pause on the deficit-based tariffs would be effective immediately and a base tariff of 10% would be enforced. Trump said he felt the pause was needed because more than 75 countries had contacted his administration to make trade deals. Each one of these solutions is going to be bespoke. It's going to take some time. So that's why we're doing the 90-day pause, Treasury Secretary Scott Bessent said at a press conference after Trump's post. The widespread tariffs of varying degrees on trading partners worldwide went into effect just after midnight on Wednesday. The reciprocal tariffs included 20% on goods from the European Union, 32% on Taiwan, 24% on Japan, and 25% on Vietnam. Bessent said the base tariff also applies to Mexico and Canada, which were not included in the original round of reciprocal tariffs announced a week ago. Trump's post also said that China would not receive a reprieve and tariffs on the country would increase to 125%. So I found some of the narrative and some of the conversation around this week to be very, very amusing. So immediately the left kind of went to this narrative of like, oh, well, Trump, he panicked and he blinked and the market was crashing. And so he realized that, oh, I screwed up and I had to do something. No. This is going exactly according to plan. They knew that this was going to happen. They knew that these countries were going to all come running in to make a deal because, like I've been saying for weeks, we have these countries over a barrel. Their economies will not last if they cannot sell their wares into the U.S. economy. Okay, it's just that simple. So we have all the leverage on these countries. So I knew that they were going to run back to make deals. And anybody who says that tariffs do not work, okay, the first thing you could say to them in response is that if they do not work, then why is it there's 150 countries around the world that all use tariffs every year and use them against the United States? Seems to work perfectly fine for those other 150 countries out there, but it just doesn't work here for the U.S., right? And you could see what happened the minute that Trump just threatened to put reciprocal tariffs. What happened? They all come running back in. Half these countries came running back in to make a deal. So you almost have to find it comical. Now, what's even more amazing is that China has put themselves in a horrible situation. I mean, they've put themselves in a massive hole here. And instead of just coming back to the table and saying, "Hey, let's work on this. Let's maybe negotiate and figure something out." No. They went full bore, and so now they're hit with 125% tariff. And I think that number is probably just going to go higher because I don't think that they're going to relent. They're going to give in. Now, you have to give credit to countries like Vietnam, Taiwan, Japan. Even a lot of countries, I would say, like, Cambodia, Thailand, they see a beautiful opportunity here for them. Like, in other words, they look at China as this huge market, as they should. It's the number 2 economy in the world. And they're looking at it and they're going, if we can just take a little piece, if we can get our carving knife out and we could just carve off a little piece of the corner here and take that business away from China, okay, that money will come flooding into our economy and we will have an economic boom, perhaps even a boom bigger than anything they've ever seen before. And that's just by taking a small piece, a couple percentage points away from China and their market. And so, again, I applaud these countries for basically recognizing the opportunity and running in. And basically, the more China holds out, the worse it's going to be for them because all these other countries are just going to come in and take their business. That's what's going to happen. So the longer they hold out on this, they're just shooting themselves in both feet at this point. So it's pretty interesting to see. But my point here is that the plan is working precisely as it's supposed to work. They put the tariffs on. 75 countries immediately come running back. They want to make a deal. They've got 90 days. They will work out deals with I would say with all of these countries. They will work out some kind of deal. Now, here's what I think the deal is going to be. I think with many of these countries, it's going to be, okay, you drop your tariffs completely. You're going to drop your tariffs to zero, and the U.S. is still going to maintain some kind of tariff on you of maybe 10% or 20%, whatever. And that's just how it's going to be. And they're going to be fine with that. They're going to be fine with that. They're going to go right in. And then some countries, it'll be, okay, we're going to have tit for tat. We're going to, you're going to hit us with 10%. We're going to hit you with 10%. Okay, that's fine. Some countries will be 0-0. So it all depends on the country and their situation, the economy, how they trade with us. All that stuff will, come into play. But another argument, another piece, and this is where a lot of the political argument falls apart, and that is, I did an episode a few weeks ago where I talked about the trade deficit. I talked about tariffs and I talked about the trade deficit, and I went very in depth on it. And I showed how we are running an almost $1 trillion annual trade deficit. And that cannot continue. We as a country cannot go on running an almost $1 trillion trade deficit year in and year out. That has to stop. That has to be rolled back. Even if you could take that from, say, about $1 trillion where it's at now, if you can shrink that back to even 200 or 300 billion, that's an enormous win. So even if you could shrink that, that's an enormous win. So here then is the question: how are you going to fix that if you don't use tariffs as the weapon or the mechanism to make that happen? Okay, and then you ask that to somebody, and then they just, I don't know, throw their hands up. I don't know. Oh, well, we'll have to do something else then. No. This is the way. This is the mechanism. This is your the tariffs. This is for a president. This is their ultimate weapon. And it's amazing. And I give Trump so much credit here, because he's the only president in the last 50 years to figure out that, like, wait a minute, if I use tariffs on other countries, they'll do exactly what I want. Like, it's amazing. Like, so, again, why other presidents in the last 50 years went brain dead and basically, or lost their backbone, lost their guts, lost their courage, whatever you want to cut up. I think the real answer goes a lot deeper than that. In terms of the politics and other stuff, but we'll leave that aside for the moment. But again, Trump seems to be the only president that realized that he had this incredible weapon at his disposal and decided to use it. And it's almost comical to find the press, just losing their minds about this whole, oh my gosh. But let's see here. I've said that this is working exactly according to plan. Now let's take a look at a few things here and see what's happening. So, all right, now I'm going to come back to the Treasury Besant here, because I want to look at a couple other things. So let's see here. Yes. Let's see here. U.S. crude oil closes below $60 per barrel. And it says, as sell-off continues on fears of full-blown trade war. Okay, I think a little bit much there on the end. But what does it say here? U.S. crude oil closed below $60 per barrel on Tuesday. Wait for it. The lowest level in 4 years. The lowest level in 4 years, as of course, as traders fear that President Trump's sweeping tariffs will trigger a full-blown global trade war. Yeah, okay. But the point being there is that crude oil is down to below $60 a barrel. It's the lowest it's been in 4 years. Do you think that's an accident? Do you think that happened by happenstance? Do you think maybe that there's something that this administration is doing a little bit better than the last one? Something to think about. Let's go on here. What's this? Falling wholesale prices could mean cheaper eggs soon. Oh, interesting. So let's see here. Part of the drop can be attributed to a 30% drop in egg prices, while an 11% drop in fuel prices also had an impact. Wow. So fuel prices are coming back down and egg prices are dramatically dropping. Wow. That's interesting. So let's see here. so we'll come back to the consumer sentiment in just a second. Let's see here. What's going on with inflation this week? Oh, let's see here. Wholesale prices unexpectedly fell 0.4% in March, showing easing inflation backdrop ahead of tariffs. But wait a minute. I thought the tariffs were supposed to I thought tariffs were going to cause all this inflation. I thought they were going to dramatically inflate everything. It couldn't be that these guys, once again, have it totally wrong. Somebody might have told you that the tariffs were not going to cause inflation, that they were actually going to decrease the inflation because the tariffs were going to, wait for it, slow everything down. They were going to start to slow things down, and that was going to bring the inflation down with it. Okay, so again, the market backing off, having a stock market correction, having the economy ease a little bit, that is not a bad thing in this situation, and that is being done on purpose to, wait for it, get the desired effect here, to get these wholesale inflation prices down. So what did it say here? The producer price index declined a seasonally adjusted 0.4% for the month after rising 0.1% in February. Economists surveyed by Dow Jones had been looking for an increase of 0.2%. More than 70% of the slide in final demand prices came from a 0.9% tumble in goods prices, a key measure as policymakers look for inflation drivers. So wholesale prices unexpectedly fell in March, setting up a favorable inflation backdrop as President Donald Trump began intensifying tariffs against U.S. trade partners. The producer price index, considered a leading indicator for pipeline inflation pressures, declined a seasonally adjusted 0.4% for the month after rising again 0.1% in February. Excluding food and energy, the so-called core PPI also dropped down 0.1% against the estimate for a 0.3% increase. The index, less food, energy, and trade services, increased 0.1%. So exactly. And now wait for it. Let's keep going here because it keeps getting better. Inflation rate eases to 2.4% in March, lower than expected. Core at 4-year low. Wait, what? What? The core at a 4-year low? The consumer price index fell a seasonally adjusted 0.1% in March, putting the 12-month inflation rate at 2.4%, down from 2.8% in February. Excluding food and energy, the so-called core inflation rate ran at 2.8% annual rate, having increased 0.1% for the month. That was the lowest rate for core inflation since March of 2021. So, to recap for just a second, we have 3 key inflation indexes that we look at. We look at the PCE, we look at the PPI, and we look at the CPI. We just got the PPI numbers coming down, the CPI numbers coming down. The PCE numbers that came out last week were just even. And so here we are. We're beginning to see it. Now, I would preface this. I would pump the brakes just a little bit, and I would say that 1 month does not make a trend. We need to see more of this. We need to see this, over the next 6 months. We need to see what happens. But my bet is you will see the economy begin to ease. You will see, again, we might see the unemployment rate creep up a little bit. We might see some layoffs. We might see, some quasi recessionary type conditions. But the side effect is going to be that this stuff is going to work out for us. All of this inflation is going to ease. Remember, as per Jeremy Powell at the Fed, what is keeping him from reducing the interest rates? It's inflation. If inflation starts going down and starts getting down to his 2% target, or maybe even a hair below his 2% target, he is not going to be able to argue that he can't lower interest rates. That argument is not going to hold water anymore. He's going to have to act. He's going to then be forced to do something, because that's all he's standing on at the moment. So, but let's read here for a second here. So, consumer price inflation eased more than expected in March as President Donald Trump prepared to launch tariffs. The consumer price index, a broad measure of goods and services costs across the U.S. economy, fell a seasonally adjusted 0.1% in March, putting the 12-month inflation rate at 2.4%, down from 2.8% in February. Excluding food and energy, the so-called core inflation ran at a 2.8% annual rate, having increased 0.1% for the month. That was the lowest rate for core inflation since March of 2021. Wall Street had been looking for a headline inflation of 2.6% and core at 3%. So, and so we could see here that the core number at 2.8, and in the last couple of months, that was actually running over 3%. But let's see something here for a second here. So January, it was at 3.3%, and then February 3.1, and then March, it's now down at 2.8. So we have a 3-month trend of the core decreasing for the last 3 months. We can also see here what was the just the regular number. January 3%, February 2.8%, March 2.4%. Again, we've got 3 straight months now of this inflation beginning to come down. So we're starting to see the pattern. It's not there yet. We need to see a lot. We need to see more of this, but we could begin to see here that we're heading in the right direction, and you could begin to see how the plan is unfolding. Now, if anybody who watched last week, you saw I can't think of the lady's name off the top of my head for just a second, but I ran through her whole like thread that she had up on X. I ran through that whole thread, and I thought she did a wonderful job of laying out the exact scenario, laying out how everything was going and how this whole thing was going to play out, and how basically the White House is looking to basically, you don't want to say mess the economy up, but you basically, they want a softening. I'll call it that way. They're looking for a softening of the economy. And the reason why they want the softening of the economy is so that they can bring these inflation numbers down, that they can get prices on things down, make it more affordable for everybody out there. And then also they want to bring, energy prices down. They want to bring the gas prices down, again, trying to make it cheaper for everybody. Again, drill, baby, drill, get the energy going, and thus trying to get the prices down. So people, again, it could become hopefully affordable for people to live again. Then it's the tariffs to work on the trade deficit. Then it's to basically start cutting money, or start, if we go back here, it's to, again, hopefully start chipping away at this budget deficit, this massive budget deficit here. So that's, so again, and that leads us to this right here. So the consumer sentiment tumbles in April as inflation fears spike, University of Michigan survey shows. The University of Michigan Consumer Survey's mid-month reading on sentiment fell to 50.8%, down from 57 in March, and below the Dow Jones consensus estimate for 54.6. Respondents' expectation for inflation a year from now leaped to 6.7%, the highest level since November of 1981, and up from 5% in March. Now, let me just ask a question. Why do you think here, and I would love if anybody wants to throw a comment in at any point, feel free. Why do you think that the respondents might think that inflation is going to have this dramatic rise? Could it be that all of the mainstream news media is in full-blown panic meltdown mode, and everything out of their mouth is inflation, 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 the tariffs, that's all they're going to cause is inflation, inflation, inflation? Could that have anything to do with it? Could the press be manipulating, in a certain respect, the views and opinions of people out there? I certainly think so. Let's see here. So consumer sentiment grew even worse than expected in April as the expected inflation level hit its highest level since 1981. A closely watched University of Michigan survey showed Friday. Now, again, keep in mind here, this is not real inflation. This is not real inflation. This isn't the reports that we just looked at. It's not the real economic numbers. It's just what people think or what they expect to happen. Okay, so you have to keep that in mind. It's a survey based on what people expect is going to happen. Now, what I also say is souring consumer sentiment. Is that a little bit a part of the plan? Yes, it is. It is, but this is a little bit a part of the plan. But I also think that this survey is a little bit manipulated. It's biased. And again, the survey's mid-month reading on consumer sentiment fell to 50.8%, down 57 in March, and below the Dow Jones consensus estimate for 54.6. The move represented a 10.9% monthly change and was 34.2% lower than a year ago. It was the lowest reading since June of 2022 and the second lowest in the survey's history going back to 1952. As sentiment moved lower, inflation worries surge. Respondents' expectation for inflation a year from now leaped to 6.7%, the highest level since November of 1981 and up from 5% in March. At the 5-year horizon, the expectation climbed to 4.4%, a 0.3 percentage point increase from March and the highest since June of 1991. Other measures in the survey also showed deterioration. The current economic condition index fell to 56.5, an 11.4% drop from March, while the expectations measure slipped to 47.2, a 10.3% fall, and its lowest since May of 1980. On an annual basis, the two measures dropped 28.5% and 37.9% respectively. Stocks turned negative following the report, and Treasury yields added to gains. So we're going to talk about some yield curve stuff here in a minute. But again, this you're beginning to see, we're at the very, very beginning. We're at the very beginning stages of a major transformation in our economy. And you have to understand there's going to be some bumps in the road. We're going to have some weeks like this where the stock market is going to go up and down. But one thing that I want to remind people about right now with the stock market. So this is not the year 2000, okay, when we had the dot-com bubble and the dot-com bubble burst. This is not that. And if you remember back in those days, the Dow was pushing up, trying to hit 10,000. I remember that very vividly. And so think about it from a percentage standpoint. So if the Dow in 2000, if it dropped 1,000 points, you're down 10%. If it dropped 2,000 points, you're down 20%. So if you had a 10 or 20% drop in a single day, obviously, yeah, that's a Black Friday or a Black Monday type event. That's basically 1987. What Jim Cramer was on there melting down about last week. Monday was going to be it was going to be Black Monday. It was going to be it's going to be the meltdown of all economic meltdowns. But that didn't come true. But I want everybody to realize, the Dow Jones has been at a high of 46,000. It's not at 10,000 anymore. It's 46,000. If the Dow swings 1,000 points up or down in today's world, nobody notices. Nobody notices because it might look good on CNBC here for a headline. Oh, the market dropped 1,000 points, but it doesn't have the impact that it did, 20 years ago, 25 years ago, because of how crazy big the Dow has gotten. Now we could have some other much deeper conversations about the value of the stocks in the Dow and about whether or not, how inflated those values really are. And I probably should have, that we probably should get into that discussion at some day. But we're going to skip that for the moment. I just want to make the point of, if the Dow is up or down a couple thousand points in a given day, really not that big of a deal. It's really not that big of a deal anymore. Now, listen, I'll be the first to admit, hey, you see the Dow, if the Dow drop, like we had that one day where it did, drop like 5,000. All right. Okay. Now you're starting to get people's attention. Okay. If the Dow drops, 5,000 points, if it drops 10,000 points in a day, okay. That's getting a little bit more concerning, but again, flipping 500 points, 1,000 points one way or the other, that's, okay. It's not that big a deal. It's not Armageddon. It's not, you're not selling all your stocks. You're not jumping out the window. It's not, it's like, let's just chill, relax. I've been telling people for months, and I tell people since, the beginning of the year, this is going to be a choppy year. We're going to have a lot of ups and downs this year. Just prepare yourself. I think the best thing you can do is just don't look, don't look at stuff right now. don't sit there and watch the market. If you can't take it, or if it's too upsetting, just don't watch the market fluctuations day in and day out. Just sit back and enjoy the ride. But I think the worst thing that anybody could do at the moment is panic. The worst thing you could do is panic at the moment and just run in and say, "Oh my gosh, the market's down a little bit. I got to sell. I got to sell. I got to get out." Just relax. Just chill. This is all part of the plan, and you got to give the plan a chance. You got to let the plan play out. I think in 6 months we are going to be looking at this whole thing a lot differently. I'm not saying it's going to be perfect in 6 months. I think, again, I think the rest of the year, we got 8 more months to go here before the end of the year. But I think 6 months from now, as we approach the end of the year, I think things are going to hopefully begin to start to look a lot better. That's my prediction. We'll see if it comes true. You guys can hold me to it. I hope you do. Okay, but let's go back in here for a second. So I wanted to. This is really big, and I wanted to go into this. So, Treasury Secretary Scott Bessent, he went and spoke at an ABA, American Bankers Association conference this week, and to say that he basically, and again, this is the banker next door. This is a channel all about banking and finance. But to say that he hit the bankers right between the eyes would be an understatement. And I think for the most part, they kind of took it pretty well. I give my brethren some kudos for taking it well. Treasury Secretary Scott Bessent says it's Main Street's turn. After Wall Street grew wealthy for 4 decades, it's now Main Street's turn. I like the sound of that. I like the cut of his jib, as they say. Okay, Treasury Secretary Scott Bessent said Wednesday that President Donald Trump's aim is for Main Street businesses and consumers to thrive, even as the administration's steep new tariffs threaten to tip the economy into a recession. For the last 4 decades, basically since I began my career in Wall Street has grown wealthier than ever before, and it can continue to grow and do well, Bessent said at the American Bankers Association Washington Summit. But for the next 4 years, the Trump agenda is focused on Main Street. It's Main Street's turn. It's Main Street's turn to hire workers. It's Main Street's turn to drive investment. And it's Main Street's turn to restore the American dream. Trump's imposition of higher tariffs a week ago has fueled the biggest 4-day rout for stocks since the onset of the pandemic in 2020. The S&P 500 is nearly 19% off its record high from February, inches away from a 20% bear market. Ooh. But of course, this was a few days ago. It's obviously popped back since then. While the wealthy own the majority of stock, Main Street's participation has soared with the advent of individual retirement accounts in the 1970s and 401ks in the presidency of Ronald Reagan. What's more, the stock market helps form business confidence, which in turn affects small businesses. Bessent, a hedge fund veteran, founded investment firm Key Square Capital Management based on Madison Avenue in New York City after working with George Soros for years. He has become the main economic spokesman for Trump's agenda of tax cuts, deregulation, and trade rebalancing. We want to deleverage the government sector, re-leverage the private sector. We can't do it all at once, or that will cause a recession, Bessent said. What will keep us from having a recession is making sure that the tax bill doesn't expire, adding back 100% depreciation, and then adding some of President Trump's agenda. No tax on tips, no tax on Social Security, no tax on overtime. Recession fears have climbed as the Trump tariffs spur uncertainty over how wide the trade war will spread and its impact on the pace of economic growth, inflation, and corporate profits. JP Morgan Chase CEO Jamie Dimon said Wednesday he sees the economy likely headed for recession because of the trade battles. Now, like I said, we will get to those comments here in a little while. We're going to look at comments from Goldman Sachs. We're going to look at comments of Larry Fink from BlackRock. We're going to look at comments from Jamie Dimon. I got comments from a few people. See how a couple people are looking at this whole situation at the moment. None of them looking at it real rosy, to be sure. But what I really want to drive home here is you can't underestimate the impact of this speech from Scott Bessent at the walking into the lion's den, so to speak, okay, walking into the ABA and basically telling them that, hey guys, we want you to do well. It's not that we want you to do bad, but you're not going to be our emphasis. You're not going to be our emphasis. And if you guys don't really do that great over the next 4 years, we're okay with it. We're okay with it. We're not all that upset about it, because it is time to grow Main Street. It's time to grow jobs and get more jobs in in the heartland and in manufacturing. It's time to get all of that rolling again. And I love it. As they say, I am here for it. I am here for it. So this was just a monumental speech this week from Secretary Scott Bessent, and they are driving home the tone. The tone is that, hey man, it is time for Main Street and Wall Street. Love you, but you're going to take a back seat for the next 4 years. So, again, very, very interesting. Now, what else happened this week? Well, they did have a 10-year Treasury bond auction that actually went off pretty good on Wednesday. So that helped to basically, as the headline reads here, 10-year Treasury yield falls from highs after auction eases concerns about demand for U.S. debt. So, this is very, very important. The 10-year Treasury yield retreated from its highs of the day after a successful bond auction eased concerns about demand for U.S. debt. The bond market, not a plunging stock market, has been the talk of Wall Street, with prices tumbling and yields spiking. Unusual action during times when fears of a recession are growing, and fixed income is usually relied on as a safe haven from turmoil elsewhere. But now we're going to look. I'm going to skip this because we're going to look at some of the yield numbers here in just a second. But the point I wanted to drive home with this article is that they had this 10-year Treasury bond auction, and it went off, and it went fine. It went actually pretty good, and that's a good sign. What would be a bad sign, a really bad sign, is if these auctions start to go bad. If the U.S. has a hard time selling its debt at these bond auctions, look out. That's going to be a very big deal, and that's going to make for some bad moments. So, but like I said, for the moment, it's hanging in there, and it's hanging in there quite well. So, like I said, just wanted to point that out. Okay, so we talked about oil, we talked about eggs, consumer sentiment, we talked about that. Let's see here. Okay, let's say this is a good one. So here's the inflation breakdown for March 2025 in one chart. So like I said, as we saw that the inflation was going down. So here's the inflation breakdown for March of 2025 in one chart. So these are some of the core categories plus other items with notable year-over-year price changes. So all items, again, sitting at 2.4%. Food at home, sitting at 2.4%. Food away from home, 3.8%. And then all items less food and energy, although i.e. the core number, sitting at 2.8%. So this is really what we need to work on here. This food away from home. So in other words, eating out at restaurants, we really need to get this number here to come down. Obviously, it's been coming down. It's retreated back to 3.8%, but we need it to come down a lot more. And obviously, as all of these numbers, as all items, food at home, all items less food and energy, the core number, as those numbers continue to come down, that's a good thing. So again, we could see here now, eggs still up there at 60.4%, but that has come down a long ways from where it was. I mean, this was over 100%, well over 100%, just a few weeks ago, and so we've really seen an impact here. Instant coffee still sitting at 13.2%, uncooked ground beef at 10.4%. Uncooked beef roast, 8.9%. Juices and drinks, 6.5%. Fresh sweet rolls, coffee cakes, donuts, 5.6%. Butter, 5.5%. Candy and chewing gum, 5.4%. Other condiments, 5.3%. Ham, 4.6%. Apples, 4.6%. Bacon, 4.5%. Dried beans, peas, and lentils, 3.6%. Breakfast cereal, 3%. Fresh milk, 3%. Flour and prepared flour mixes, 2.9%. And then it gets into some of the categories here. So let's see here. So food away from home. Again, we said 3.8%. So that is vending machines plus mobile vendors, up 6.7%. That's pretty steep there. Full service meals and snacks, 4.1%. Energy was negative 3.3%. So gas services coming down. It's still at 9.4%, but coming down. Electricity, 2.8%. And then here's basically your core. So some interesting ones here. Admission to sporting events, 25.8%. Man. Those sporting event tickets are hitting me high. I guess maybe it's all those multi-billion dollar valuations they keep selling these teams for. Maybe that might have something to do with the dramatic jacking up of the ticket prices. College textbooks, 13%. Ugh, killing me. College textbooks, you're killing me. Rental of video plus video games, 10.7%. We got to get the guys out of the bedroom. Got to get them out of the bedroom. Stop playing too many video games. Got to get them out of the bedroom. Laundry equipment, 8.7%. Cigarettes, 7.6%. Motor vehicle insurance, 7.5%. Motor vehicle repair, 6.4%. Apparel services and dry cleaning, 6.4%. Delivery services, 6.2%. Veterinarian services, 5.9%. Newspapers and magazines, 5.7%. Daycare plus preschool, 5.6%. Garbage plus trash collection, 5.3%. Jewelry, 5.1%. Club membership, 4.9%. And laundry and dry cleaning services, 4.9%. So again, that gives you a very good overview of just where a lot of things at in terms of the price inflation. So good information there. Okay, now let's talk about the Treasury yields for a minute here. So this was from just literally a few hours ago. This was the 10-year Treasury yield, tops 4.5% after surge this week. That's worrying Wall Street and the White House, as it should. So I would say this is the one thing that is not working in our favor at the moment. This is the one thing that is going in the wrong direction. Again, part of the plan here, if you will. Scott Bessent, he has to roll over $9.2 trillion in short-term T-bills into long-term T-bills. That is a huge part. It's a third of our national debt has to be rolled over in 1 year. Thank you, Grandma Janet Yellen. So that has to be rolled over. And obviously, if you can roll that over at much cheaper rates, that is really going to help us get where we want to be. But again, because Jeremy Powell doesn't want to decrease the rates, and because we're seeing this sting. Now, I think there are two very critical things happening here that are driving this. First of all, what is one of the tools that China has at their disposal to basically hurt us? Well, they own a lot of our national debt, and they own that in the form of a lot of bonds and treasuries. So they could go on the market and they could dump a big chunk of said bonds and treasuries, and that would send prices tumbling, and that would send the yields soaring up. So they could continue, at least in the short term, to drive these yields up, particularly the 10-year Treasury yield, which hurts us a lot, because as I've said many times before, everything in your retail life is driven by the 10-year Treasury. Your residential mortgage rates, your auto loans, your student loans, your credit cards, it is all driven off the 10-year Treasury. So as that 10-year Treasury yield goes up, that's gonna sting. So this is the one thing that's not working in our favor. So I think two things could be happening here. One is China's dumping a bunch of treasuries and bonds. Number two, you have this thing called the basis trade. Let me see if I can find something on my good buddies here over at Zero Hedge. Let's see here. Where am I? I'm looking at here if I could find this. Yeah, this is. I'll have to talk about this in a minute. But the Federal Reserve found rampant mortgage fraud at Fannie Mae and Freddie Mac. Rampant, as in massive. Yeah, that is a fascinating story. You didn't hear about that one this week, did you? Okay, but I'm looking for this basis trade, and of course now it's gonna switch up on me and jump to like 5 months ago. All All right, I don't know where that went, but yeah, so there is a certain trade called the basis trade, and it is a trade that hedge funds basically use. And I'm still trying to see if I could find it in here. Um, mm, I'm still not. Yep, still not seeing. This thing drives me nuts sometimes. It throws you back like 5 months as you're just going through it. It's really annoying that they do that. All right, but anyway, um, so you have this thing called the basis trade, right? And so hedge funds have this basis trade, and how the basis trade work is it's just it's kind of an arbitrage where you're taking some treasuries and some bonds, and you're positioning them so that you just make a tiny little bit of money. Again, it's an overnight trade. It's a tiny little bit of money, but if rates fluctuate even just a little bit, the whole trade could get blown up. And so think about it like this. You as an individual, you found a way that you could do a very simple trade every month that made you $1,000 a month, right? It's not earth shattering. It's not gonna dramatically change your lifestyle or anything like that. But it's nice. It's a nice $1,000 that you can make with basically very little work, very little effort. All you got to do is just place a couple hundred of these trades every month, and the computer system will do it for you automatically. It's like almost like on autopilot. And and so basically that's what the hedge funds are doing with the basis trade. They put in thousands of these trades every month. They're simple little trades, overnight trade, doing it and basically trading in the repo market in a lot of ways. And this basis trade, when you have these kind of rapid fluctuations in the treasury yields, it blows up the basis trade. And what the net effect of that, if you will, is that can really mess up a lot of these hedge funds that are trading this trade. And that could also be having an effect on the treasury yields that we're seeing. And like I said, Zero Hedge did some great reporting on that exact topic this week. Japan had the same thing. They called it the carry trade. They had the exact same kind of trade but they just called it instead of the basis trade, they called it the carry trade. I also talked about if you guys remember back in August of last year when Japan's market almost blew up and they had a meltdown there for a couple of days. That was because they had this thing called the carry trade, which went the wrong way on them and blew up because they increased their interest rates. And so basically they had the carry trade, we had the basis trade. Now, I talked a lot about the basis trade in the Lords of Easy Money series that I did. If anybody hasn't had a chance to check that out, please go check that out. I think you will learn a lot. If you want to understand what's going on today and how we got here, you got to go watch and listen to the Lords of Easy Money series. But the basis trade became a very big thing at the end of 2019. And the only reason that you didn't hear about it was because we had this little COVID thing that popped out 3 months later that basically blew it off the headlines, and they were able to salvage it through turning the money printer back on, and that basically solved the short-term problem and got rid of it. But the bigger issue is that it was never addressed. The Federal Reserve just swept it under the carpet. They bailed out all the hedge funds. They swept it under the carpet, and then they acted like it never happened. And then they've basically just allowed the hedge funds to just keep on doing it. So again, it's not like this thing is making the hedge funds a ton of money. But if the trade goes the wrong way on them, they can lose a ton of money. So that's just that. So just kind of keep those things in mind. But that is the kind of stuff right now that is affecting the 10-year treasury here. So let's just look at this for just a second here. So the 10-year treasury yield tops 4.5%. The 10-year Treasury yield climbed higher Friday, adding to its steep weekly rise. A dizzying trade moves by President Donald Trump caused investors to dump U.S. assets in favor of other global safe havens. The benchmark 10-year Treasury yield advanced 9 basis points to 4.486. It earlier jumped to its highest level since February 13th. The 2-year Treasury yield climbed 12 basis points on the day at 3.97%. 1 basis point is equal to 0.01%, and yields move inversely to prices. So the 10-year Treasury yield this week has risen more than 50 basis points after ending last week around 4%, marking one of the biggest spikes on record. And thus, this is what I mean by blowing up the basis trade. You know, if the Treasury yield moves 50 basis points in a week, your trade just got blown up. So the move marks a stark reversal in how investors view treasuries. Traditionally, investors have turned to U.S. debt as a safe haven during tumultuous times. That doesn't appear to be the case this week, as China and Japan appear to be selling treasuries. Oh, what did I just say? What did I just say? What was the first thing that I said? Part of probably what's going on here is that China is dumping bonds and treasuries because they're just, that's the one, that's the knife they got that they could stick us with that one knife right now. Japan and China appear to be selling treasuries amid the heightened trade tensions as traders speculated. The move higher may be complicated. The move higher may have complicated the White House's approach to the trade. So yes, possibly. But let's look at. All right, we're going to come back to this in just a second here. So a couple other things I just want to show you guys real quick here. So this is the Treasury yield curve. We have looked at this in the past. So you could basically the zero line here in the middle, this dark line that runs through here, that zero, that is basically the break-even line. As the blue line goes below here, this is what you called an inverted yield curve. As it goes back up above 0%, we now have what's called a normal, or we begin to have what's called a sloping yield curve. So, and this was one of the longest and deepest yield curve inversions in history. The only one that was longer and deeper was the one right before the Great Depression in 1929. So it kind of tells you a little scary. But basically, we went back to positive territory basically around August timeframe of last year. It trended down basically around December. It looked like it might about to go negative again, but ever since then, it's kind of bounced up and it has stayed in positive territory. Now, what does that mean? That means that the 10-year Treasury is higher than the 2-year Treasury. The Treasury yield curve is the difference between the 10-year and the 2-year Treasuries. So right now, so as long as the 10-year Treasury stays higher than the 2-year Treasury, we have a positive yield curve and things are in good shape. So I wanted to show you that for a second to basically say that, like, hey, things are, but you have to remember one key principle. While the yield curve is not the yield curve inversion and then reverting back to a positive yield curve, while it is not 100% predictor of a recession, it's like a 95% predictor of a recession. So it's pretty strong. And it's a lagging indicator, meaning that it doesn't happen right away. It can take a few months. It could take 3 months or 6 months for a recession to kick in after this is gone that way. So would it be surprising for us to roll into a recession here soon? No, it wouldn't. And depending on the GDP numbers, it might become a reality here, just in the next, couple months. But we'll see. So like I said, I wanted to point that out. Okay, now let's look at the yields for a second here. So let's look at the bonds, the Treasury yields. So here we got the 30-year, 10-year, 7, 5, 3, 2, 1, and then the 6-month, 3-month, and the 1 month. So let's look at the 10-year here for a second. So this is just the day, but I want to take a look at the 5-day here. So we can see on April 7th, we were literally sitting here at 4%. And now here we are today sitting at just under 4.5. We're sitting at 4.491. So we basically in a week, we went up 50 basis points. So huge jump in a 1 week time frame. Again, the 10-year treasury yield does not usually move. It does not usually have spikes like that. But again, this was spiking, I believe, for two main reasons, because China and Japan were basically dumping US treasuries, and you had this basis point trade amongst a whole lot of big hedge funds completely blow up. And that's what caused this to spike this week, up 50 basis points here. So but again, let's look at, the 2-year though, sitting here at 3.977. So again, lower than the 4.494. But if we come down here to the short-term T-bills, we still got 6-month is sitting at 4.2. The 3-month is sitting at 4.32, and the 1-month bill is sitting at 4.293. So still relatively higher. All three of them higher currently than the 2-year, which is not a great sign, but still slightly below the 10-year treasury, which is keeping us from having an inverted yield curve. So that's basically where we're sitting right now. So I do believe that the 10-year treasury, it will settle down. It will come back down as a lot of this stuff calms down. But I would say we are probably in for a choppy couple of months. I think it's a couple, a lot of this is going to fluctuate up and down, because the trade news is going to be you just have to accept the fact that the tariff news is going to be very up and down for probably the next 2 or 3 months. China's not going to back down anytime soon. They're going to continue to basically keep digging themselves a deeper and deeper hole. But a lot of other countries are going to come to the table, and they're going to cut a lot of deals. And Trump is going to go back and forth. He's good. That's his negotiation tactic here. One day more tariffs. The next day, I'm going to back off. The next day, more tariffs. The next day, I'm going to back off. Like that. That's what he's going to do here until he gets what he wants. He's going to continue with that. So we're going to continue to have these kind of ripples in the market, ripples in the bond market and the stock market. And we're going to, this is what we're going to continue to see. It's going to continue to be, I think, a little choppy here for the next couple of months. Okay. Let's hit on, let me just see something here. All right. Before I get to mortgage rates, because I do want to talk about that for a second, just two things I wanted to hit on real quick. So gold hit record high, and minor stocks surge amid tariff uncertainties. And then also we got Bitcoin drops to 77,000 as crypto shares slip. Now, Bitcoin did recover a little bit of this pricing here. Let's go back to our nifty chart here on the Wall Street Journal, and let's take a look at commodities for a second. So we can see gold here. Gold hit 32.55. Basically hit an all-time high. And let's go back. Now, this is the one-day chart here, but let's take a look. Let's go back 5 days here. And you can see here from April 9th, we were basically sitting at just below 3,000, and it basically shot all the way up to 32.55 in just the last 2 days. So we had a huge spike up here just in the last couple of days. Obviously, part of that is a knee-jerk reaction to what's happening with the tariffs and what was happening in the bond market. That was called, when we read in the article a few minutes ago when they talked about a flight to quality. Well, one of those areas that they flew to, so to speak, was gold. Flew back into gold, basically just buying gold as a hedge and making sure they have it. Now, one of the things I find interesting here is silver is still sitting tight. It's silver's still kind of hanging around there at about $32, and it did spike up here the last few days, but it hasn't really had. Like you can see here, this is over the last year, and a year ago today we were sitting at $29, and it's about 32, so it's moved about $2 in the last year. So haven't really seen this big spike up in silver. Which again is a little surprising, because I figured it would spike up a little bit more, but we'll see. But like I said, we'll continue to keep an eye on that and see what happens. Now let's look at cryptos for a minute. So Bitcoin here, as you can see here from this chart, for the last 5 days, they've been on a little bit of a roller coaster here. So basically, we started out on April 7th, and we were down to about 78,000. And then it bumped up to 80,000, fell back down here to just below 75 on April 9th, and then basically shot back up to 83,000 here April 10th, dipped back down, and then came all the way back up to about 83, and then came back and is still sitting at 83,354. So Bitcoin been on a little bit of a roller coaster here for the last few days, and again, I think this will probably continue. I think we'll probably continue to see this little bit of a roller coaster here out of Bitcoin. So, all right. So let's see here. Mortgage rates. So, and again, this was just from a few hours ago. This was basically about 2 o'clock today. So mortgage rates surge over 7% as tariffs hit the bond market. So obviously, like I said before, your 30-year mortgage rate is tied to the 10-year treasury. So we just saw that the 10-year treasury spiked 50 basis points this week. So as that spikes, that's going to spike up your 30-year mortgage rate. So the 30-year mortgage rate jumped back over 7%. So the average rate on the popular 30-year fixed rate mortgage surged 13 basis points Friday to 7.1%. Mortgage rates are now at the highest level since February. Forget about housing in this environment, said Nancy Lazar, global chief economist at Piper Sandler. I think a little over the top there. But basically the mortgage rates, spiked up to 7.1%. And what did that do to mortgage volume? So let's see here. So we have here weekly mortgage demand jumps 20% last week as tariff volatility briefly tanked rates. So last week we saw this huge spike up in mortgage activity because the rates had dropped down. And now I'm sure this week with it jumping back, I'm sure the week to come, the rate jumping back up over 7%, that volume is going to slow down again. So, but at least in the last week, it was pretty decent. So mortgage refinance demand surged 35% in 1 week as the precious few who could benefit rushed to their lenders. Demand from home buyers jumped to the highest level in over a year. Adjustable rate loans saw strong demand as consumers sought the lowest rates possible. So volatility in financial markets caused a sharp drop in mortgage interest rates last week, which resulted in a big spike in mortgage demand. Total mortgage application volume jumped 20% last week compared with the previous week to the highest level since September of 2024, according to the Mortgage Bankers Association's seasonally adjusted index. The average contracted interest rate for 30-year fixed-rate mortgages with conforming loan balances of $806,500 or less decreased to 6.61% from 6.7%, with points increasing to 0.63 from 0.62, including the origination fee for loans with 20% down payment. The rate is 40 basis points lower than the same week 1 year ago. Unfortunately, in that just the last week, we erased that 40 basis point deficit. So again, seeing some basically like a whipsaw in the residential mortgage market right now as the 30-year mortgage rate continues to just jump up and down. I think we're going to continue to see the mortgage demand, basically it's going to be basically like a week to week thing here. So it's going to get pretty interesting, and we'll have to keep an eye on that. So, okay, now we get into some of the comments from some of the other people, but I'm going to take a break. I'm going to take a break from this for a few minutes. We'll come back to some of these articles here. It's about that time right now where so this is the time of the program where I usually like to go through the episodes that I posted up this week. And I'm also going to give you guys the economic indicators that are coming out next week. And I'm also going to give you some other banking news and other things that happened throughout the week here. So let's jump into, so on Monday, I put out episode 354, which was called How Are Banks Dealing with Unrealized Losses in Their Bond Portfolios? So this episode examined a recent article from Bank Director titled, Banks Have Been Unloading Bonds at a Loss. Is that a good thing? So for several years now, the banking industry has been dealing with unrealized losses in their bond portfolios. Many banks in the industry have been selling at a loss to reposition their bond holdings, and many banks are still holding tight. As this issue continues to persist, banks will have tough decisions to make around growth, potential mergers, liquidity, capital, and earnings. So again, keeping an eye on the entire situation with unrealized losses in banks' bond portfolios. So if you want to check that out for a little bit more in-depth discussion there on that. Then on Tuesday, I put out episode 355, which was called What's Going On with Consumer Credit Scores. So this episode examined 3 articles related to consumer credit scores. The articles included a credit score hangover is hitting America's riskiest borrowers. Steep drop in credit scores hit student loan borrowers. And credit scores of more than 9 million student loan borrowers will likely drop in the first quarter. So the first 2 articles were from the Wall Street Journal. The third was from Investopedia. Consumer credit scores are about to drop due to a number of issues that include high interest rates, student loan debt, and increasing credit card and auto loan debt. So again, if you'd like a little insight as to what's happening with consumer credit scores and why they may be dropping, check that episode out. Oh, you know what? Did I miss this? You know what? Sorry guys, I actually messed this up for a second here. I got the episode order out of whack here a little bit. So episodes 354 actually came out. That was actually on Wednesday, and 355 was on Thursday. So I skipped Monday and Tuesday. So Monday, I did episode 352, which was called Examining Javier Milei's Turnaround in Argentina. This was a very popular episode. A lot of people, I wasn't sure how this was going to go over, but people loved it. So this episode examined several articles about Argentina President Javier Milei's transformation of his country's economy. The first article was from the Wall Street Journal. It was titled, How Javier Milei's Tough Remake of Argentina Made Him into a MAGA Hero. The second article was from the Epoch Times, and it was titled, How Milei's Radical Reforms Turned Argentina's Economy Around. So Argentina, throughout the 20th century, was considered one of the most beautiful and wealthy nations in the world. But starting in basically the late 20th century, the country turned towards socialism with disastrous economic results. Javier Milei is working to turn the country around with what he calls classical liberal and anarcho-capitalism beliefs. And the question was, is it working? And the answer is yes, it is, and it's working in a very big way for that country. So if you're interested in checking that episode out, please do. Like I said, it was very, very popular episode this week. A lot of people checked it out, got a lot of comments and positive feedback on it. So so go check that out. Then on Tuesday, I did episode 353, which was called What is a Merger of Equals? And this basically looked at, this episode discusses the concept of a merger of equals in the banking business, and then walks through a recent example of a merger between Berkshire Hills Bancorp and Brookline Bancorp, as it was outlined in the bank slate. So a merger of equals transaction can prove tricky to pull off, but can also be very beneficial for both banks in the long run. So if you've got interest in learning a little bit more about merger equals, check that out. And then, like I said, on Wednesday, episode 354, how are banks dealing with unrealized losses in their bond portfolios? Then on Thursday, episode 355, what's going on with consumer credit scores? And then finally on Friday, I had episode 356, which was how did JP Morgan get duped for $175 million. Yes, how did the largest, biggest, baddest bank in the world get duped by a young girl for $175 million? And so that episode, again, very popular episode. A lot of people liked it. So this episode examined 2 recent articles from the Wall Street Journal that were titled, She's Accused of Duping JP Morgan. Somehow the bank is feeling the heat. And Charlie Javis found guilty of fraud in JP Morgan case. So Charlie Javis was an entrepreneur who started a company called Frank that helped students get access to financial aid. JP Morgan was so impressed with the company and its founder that it decided to purchase it for $175 million in 2021. Shortly after the purchase, however, JP Morgan figured out that they had been duped. And basically all of the customers, they thought they were buying a list of more than 4 million customers. Turned out she only had a little over 300,000 customers. Whoopsie. And she basically, it was total fraudulent situation. She basically created this entire fake list of customers. JP Morgan figured it out after the fact, sued her. And, so as the case, which ultimately got decided in court, I kind of spoiled the ending. Charlie Javis, this young girl, she got found guilty. Probably going to spend a long time in jail. Probably going to go to jail for, I would imagine, probably 10 to 20 years. I would think. Yeah, not going to be a good time for her. But again, if you're, like I said, I thought that was a pretty fun, pretty interesting story. And, and JP Morgan really came under fire there in that instance for their total lack of due diligence. Just, how the biggest, baddest bank in the world basically got suckered in to buying this girl's fraudulent customer list for 175 million. It's rather mind blowing. And of course, that's why I wanted to cover it. That's why I wanted to do a story on it. So, okay. So let's talk about, so what are some economic indicators that are coming out this week? So, we've got on Monday, April 14th, we have OPEC monthly report. We have consumer inflation expectations for March. On Tuesday, April 15th, we get the export-import price index. We also get the New York Empire State Manufacturing Index. We get the API weekly crude oil stock. And on Wednesday, April 16th, we get core retail sales. We get retail sales for March. We get industrial production, and we get the 20-year bond auction. On Thursday, continuing jobless claims, housing starts, initial jobless claims, the Philadelphia Fed Manufacturing Index, and then we get the Atlanta Fed GDP now for the first quarter. So everybody will be looking at that on Thursday, I promise you. Friday, April 18th, U.S. Baker Hughes total rig count. Now, just again, I want you guys to pay attention to this so you guys could tell me if I'm wrong, but I don't think I am. So Thursday, my guess is the Atlanta Fed GDP now number for the first quarter. It's going to be a negative number. You are going to have a meltdown. You're going to have another Jim Cramer on there, basically melting down that the world is coming to an end. So just get ready for that. I would expect that Thursday will be a down day in the markets, and they will be, they will jump all over this GDP number. Oh, this is it. This is proof that we're in a recession. It's all over. It's all going to come crashing down. So just keep it. That's my prediction for Thursday. So just keep an eye on that. We'll see what happens. But obviously a lot of some good. We're going to get some good retail numbers. We're going to get some employment data numbers. We're going to get some real estate numbers. So a lot of good economic data is going to come out this week. But like I said, Thursday with the GDP now numbers from the Atlanta Fed, that's going to be the big day. That is going to be the big moment, if you will. So, okay, let's talk about some banking news here for a moment. I got to stop. I need a drink for a second. All right, let's keep rolling here. So Donalds introduces bill to support community bank access to capital. So Byron Donalds, a Republican from Florida, introduced an ICBA-supported legislation to increase community bank access to capital. The Small Bank Holding Company Relief Act would raise the consolidated asset threshold of bank holding companies to qualify as small bank holding companies from $3 billion to $25 billion. Similar legislation to raise the asset threshold to $10 billion passed the House Financial Services Committee during the last Congress. So that's a good thing. That will help a lot of smaller banks out around the country for sure. So hopefully that goes through. Bowman. Community banking background prepared me for Fed roles. So Federal Reserve Governor Michelle Mickey Bowman said her background as a community banker, Kansas Bank Commissioner, and member of the Fed board have prepared her to carry out the responsibilities of vice chair for supervision at the agency. So speaking at her Senate Banking Committee nomination hearing, Bowman said if confirmed, she will prioritize reforming and refocusing supervision and restoring regulatory tailoring. She also discussed her experience as a community banker and the compliance burden on local institutions of implementing excessive regulations. So ICBA enthusiastically endorsed Bowman's nomination in a letter to the Senate Banking Committee ahead of the nomination hearing. In a joint letter to Treasury Secretary Scott Bessent in February, ICBA and its affiliated state banking associations urged the Trump administration to nominate Bowman. I think Bowman would be an excellent pick. So in a national news release following the nomination, ICBA said it has long been a strong supporter of Bowman. And then just a little extra background there. So Bowman, she made history as the first person to hold the Fed's community banking seat, a position created due to ICBA's successful push for congressional action requiring community bank representation on the Federal Reserve Board. She served as a fifth-generation community banker and as Kansas State Bank Commissioner before filling the community bank slot at the Fed. So that is a very important, and I would say it's equally as important if she does get the nomination and she does move on to become, the vice chair of supervision. That's great. That's a great spot for her. But I would also say it's also equally important that we get another community bank person in there to take her spot on the Fed board. So I think that is just as equally important. So OCC to notify banks with updates about email security issues. So after sharing information this week about a major information security incident, the OCC said it is contacting supervised institutions with updates about the email incident and its migration. The OCC said it is committed to transparency and would inform all supervised institutions to provide an overview of the security event. Forensic analysis efforts are underway. The next steps for impacted financial institutions. So the OCC on April 8th notified Congress of a major information security incident as required by the Federal Information Security Modernization Act. In the news release, the OCC said internal and independent third-party reviews found OCC emails and email attachments were subject to unauthorized access. On February 11th, the OCC learned of unusual interactions between a system administrative account in its office automation environment and OCC user mailboxes. On February 12th, the OCC confirmed the activity was unauthorized, activated its incident response protocols, reported the incident to the Cybersecurity and Infrastructure Security Agency, disabled the compromised administrative accounts, and confirmed that the unauthorized access had been terminated. So big issues. Obviously, we don't know what the extent of this data breach is, but I'm sure we will find out. So ICBA supports a bill to prohibit mortgage trigger leads. So ICBA expressed support for the reintroduction of legislation in the House and Senate to protect the financial privacy of mortgage applicants. So the Home Buyers Privacy Protection Act, H.R. 2808 in the House and Senate Bill 1467 would amend the Fair Credit Reporting Act to prohibit credit reporting agencies from selling what's called trigger leads. And I've done whole episodes on this. If you're interested, you could go check them out to learn a little bit more about trigger leads. So when a consumer applies for a residential mortgage, unless the consumer has opted into the creation and sale of such leads, or if certain exceptions apply. So what's been happening is, you go to apply for a mortgage and all of a sudden, within hours, you're getting just the phone is ringing off the hook. You're getting dozens and dozens and dozens of phone calls from all mortgage providers from all over the country. Yeah, hey, can we do the mortgage for you? Can we do the mortgage for you? And the problem here is that, everybody points the finger at the bank and they say, my bank did this. I went in and I applied for the loan and now the bank sold my information. And now I got all these different companies, calling me. And the problem is that it's not the bank. The bank has nothing to do with it. It's the actual credit reporting agencies, which are Experian, TransUnion, Equifax. What's happening is the bank is pulling your credit report, and then the minute the credit, say Experian, the minute Experian, sees the pull, they are then selling that information to hundreds of mortgage companies across the country, thus creating what's called a trigger lead. You pull the credit report, that is the trigger that then creates the lead that then goes out to these companies. But banks have nothing to do with it, and they have no control over it. Thus the problem, and that's why Congress is trying to put through this legislation to basically stop this from happening. So hopefully that helps with understanding this a little bit. But if you want to learn a little bit more about that, go see my episode on trigger leads. Okay, I thought this was interesting. So Independent Banker magazine, they highlighted that ICBA Payments and MasterCard recently built a partnership model centered on empowering community banks to deliver an upgraded customer experience to their cardholders while boosting card program profitability. So this upgrade to, basically the MasterCard, like debit card or credit card, if you will. So basically modern contactless plastics, a tokenization to digital wallets, industry standard 8-digit BINs, and enhancement to business BINs. So, sounds pretty good. I'm sure we'll get, more information out on that. But pretty interesting stuff there that they're teaming up to hopefully put out, like the next gen debit card, if you will. So, FinCEN holds session on Southwest border order. So the Financial Crimes Enforcement Network announced that it held 2 informal webinars regarding the U.S. Southwest border geographic targeting order with money services businesses and related trade groups, state regulators, and law enforcement agencies. So FinCEN last month published responses to frequently asked questions about the GTO to combat the illicit activities and money laundering of Mexico-based cartels and other criminal actors along the southwest border of the United States. So, and then this is very interesting. So the latest rate decision had 1 dissenting vote in the Fed minutes. So all but one of the participants in the most recent Federal Open Markets Committee meeting supported maintaining the target rate for the federal funds rate at 4.25 to 4.5%. According to the minutes of the March 18th to 19th meeting, Governor Christopher Waller agreed with the decision to maintain the target rate for the federal funds rate, but voted against the overall decision because he preferred to continue the pace of decline in securities holdings in place at the time of the vote. According to a recap of the minutes, participants generally noted a high degree of uncertainty facing the economy that could dampen consumer spending, business hiring, and investment activities. So again, very little dissent in the Fed. Again, Lords of Easy Money, go check it out. You'll understand what the deal is there with that. Okay. ICBA applauds the House passage of resolution to overturn CFPB overdraft rule. So the House voted 217 to 211 to pass a JR Resolution 18, which would invalidate the CFPB's rule to cap fees at financial institutions with more than $10 billion in assets and preclude the agency from issuing a substantial similar rule in the future. So I think consumers won't like this, but I think it's actually a good thing because again, a lot of it has to do with capping the penalty, if you will, that a bank can hit somebody for a return deposited item or for an overdraft fee. So let's take overdraft fees for a second. A lot of banks out there probably charging $30, $33, $35 for an overdraft fee. It's a very tricky thing, right? Because, again, the CFPB wanted to cap it at like $8. I would maintain that is, again, a big part of the reason why the fee is $30 or $35 is because it's a psychological deterrent. It has to be large enough that it freaks people out a little bit if you do it. I would maintain that at $8, a lot of people out there aren't going to care. They're going to be, oh, okay, yeah, I'll overdraft my account. I'll bounce 6 checks, whatever. It's $20. It's $30, whatever. Whereas, if you did that today, you get hit $30 a bunch of times, could be $150. Now all of a sudden it's like, whoa, hang on, wait a minute. So again, I mean, and I could go more in depth on the practices of banks and overdrafts and all that stuff, but we'll save that topic for another day because I want to continue on here. But I think ultimately, even though I think a lot of consumers would disagree, I think that that's actually a good thing, and it will hopefully continue to be so. So the FDIC is looking to encourage de novo bank formation. Yes, that's very good. So the FDIC is exploring ways to encourage the formation of new de novo banks to support the community bank model. Acting Chairman Travis Hill said, speaking in Washington, D.C., he wants to identify scenarios in which certain types of applicants may be subject to adjusted standards, including with respect to upfront and ongoing capital expectations. And he wants to reevaluate how the FDIC processes deposit insurance applications from organizers proposing banks with new or innovative business models. So again, good stuff. Love to hear it. OCC announces information security incident involving email. We already talked about that. Consumer credit was down in February. Consumer credit decreased 0.2% in February. Treasury announces some appointments. Rebecca Oakes Burke will serve as Deputy Assistant Secretary for International Tax Affairs. Kevin Salinger will serve as Deputy Assistant Secretary for Tax Policy. And Derek Thuryer, if I'm saying that right, is President Donald Trump's nominee to serve as Deputy Undersecretary of the Treasury for Legislative Affairs. OCC issues guidance on rescinding CRA final rule. Yes, this was huge. This was big news. The OCC issued guidance on the federal banking agency's March 28th announcement that they plan to rescind the Community Reinvestment Act final rule issued in October of 23 and reinstate the prior CRA framework. Bang, boom. Just fantastic news. Absolutely fantastic news. I love to hear it. The ICBA applauded the federal banking agencies for their announcement on the CRA rules, citing its disproportionate implementation costs for community banks. Yes, absolutely. Huge news. I mean, I think, when you take a step back and you add up all of the incredible things that have happened, BOI getting shut down, the CFPB getting shut down in a big respect, stopping the implementation of things like open banking, pulling back this overdraft rule, looking now at the CRA getting pulled back. I mean, all this over regulation that was just bearing down upon the industry. I mean, it's just been, bankers, I feel like they should be ecstatic right now because this has just been one win after the next on the regulatory. I mean, these last 3 months have been, just absolutely incredible. I think everything we could have asked for or looked for in the last 3 months has come to fruition, and we've got more to come. We got more stuff that's coming down the pike. So it's just been, I think it's just been fantastic. You look at, how M&A transactions are starting to go back to just normal timeframes. That's all anybody could ask for. Like, can we just have a normal time frame of 12 to 18 months to get a merger done? Is that cool? And that's all beginning to take shape now. So all these things are happening, and it's just really good. Let's see here. So what are the last couple things I have here on this front? So ICBA urges Congress to streamline data privacy legislation. So ICBA and other banking groups said that a national privacy standard should preempt the patchwork of state laws and recognize the strong privacy and data security standards already in place for the banking sector. So, so it could be interesting. We'll see how much there. And then again, CFPB says it will reopen the 1071 rule. So the Consumer Financial Protection Bureau said it will open a new rulemaking to implement Section 1071 data collection and reporting requirements for small business loans. In a court filing for a case brought by the Revenue-Based Finance Coalition, the CFPB said it plans to release a new 1071 proposal soon. Again, huge win. The Bureau asked the court and the U.S. District Court for Southern Florida to suspend further proceedings because the new proposal would make the court case moot, which is fantastic. Again, so that I'm sure there will be very positive changes made on the 1071 rule. Again, another regulatory hot button item moving in our direction, moving in our favor, and it's fantastic, and you love to see it. So, okay. Let me just take a second to talk about what I've got coming up here over the next couple of weeks. So I want to pull something up. So, okay. The next couple of weeks, I've got some family stuff coming on. I'm not going to be doing there. Unfortunately, I know it breaks your heart, breaks my heart. Fortunately, there's not going to be a BND Strategy Room live stream next week. I'll be back on the regular time Saturday night at 8:00 in 2 weeks. But I still have episodes coming out every day for the next couple of weeks. No interruption there of any kind. So just some of the things I've got coming up here over the next 2 weeks. So coming out on Monday, I'm going to do a review of let's see here. I'm going to do a review of Bank Directors 2025 Risk Survey. I'm going to do a review of OCC Mortgage Performance Report for the fourth quarter of 2024. I'm going to do a review of the OCC Bank Trading Revenue Report. That's also known as the Derivatives Report for the fourth quarter of 2024. We're going to have an interesting conversation about ESG and DEI. I was honestly a little nervous about covering that topic because it's such a politically charged topic. But I wanted to cover it because it is a big thing right now at the moment. So again, hopefully people look at that episode and feel that I covered the topic fairly. But we'll see. We'll see what people think. And then finally, I'm going to do let's build a high performance sales culture. So I talk about a very interesting article just on what you need to do to build a high performance sales culture in today's environment, which I thought was open. It was interesting. And then and then the week after, starting on April 21st, I'm going to have what happened when OpenAI fired Sam Altman. I think another fabulous story that people will love hearing about. How can banks utilize marketing personalization? I actually thought that was a very interesting episode that I did. This concept of marketing personalization and how it can help you better reach particularly the younger generation. How banks can fight AI-powered elder fraud. How banks can fight AI-boosted spear phishing fraud. So a couple different frauds out there. And then finally, this episode I thought was rather fun. How do you build a net worth of over 500,000? So basically, the author of that article basically felt that pretty much anybody out there could build a net worth of 500,000 if you just followed a few simple strategies. So I thought that was a fun episode. We, looking in at a couple of these different things, examining them, and then seeing what would happen from there. Couple other episodes, if people haven't had a chance to check them out, I did an update on changes to Social Security. So if you haven't checked that out, maybe you got some parents or grandparents that, again, anybody that might be getting Social Security, definitely want to check out that episode. What else do I got there? I did an update on farmer debt. Basically just looking at what they call ag debt or ag lending in the banking business. Check that out. Treasury review of First National Bank of Lindsay failure. So a small bank that failed last year. Treasury put out kind of an initial review on that. The full review will be out later this year, but just wanted to cover it. Is a bank failure, so I wanted to cover it. And then finally, the Small Business Credit Survey, which gets put out every year by the Federal Reserve banks, they came out. So what they usually do is they have the Small Business Credit Survey is a big survey, and they usually break it down into smaller reports, like smaller chunks. So usually by the end of the year, they have 5 or 6 different reports out off of the one survey. And so the first report for 2025 just came out, and this was a report on employer firms. So basically small business. So it was a report on small business. And one of the key things in there that I like to look at is how are small businesses, how are they borrowing money? Who are they borrowing money from? Are they satisfied? Like, in other words, very satisfied with community banks, not so satisfied with online lenders right now. And there's a lot of great charts and graphs and statistics and data in that report. So if you have a chance, go check out some of those episodes as well. But that's what I got. So that's the deal. That's what's happening here over the next couple of weeks. So unfortunately, no BND strategy room next week, but I'll be back in 2 weeks. And in the meantime, got episodes coming out every day, Monday through Friday. And like I said, feel free to check them out. So let's get back to some of these articles here for just a few more minutes. A couple of things I want to run through with everybody. So I'm not going to go super crazy in depth into some of these articles. I just want to I really wanted to show you guys the headlines, because I want you to see the kind of the panic out there. So JP Morgan CEO Jamie Dimon says Trump tariffs will boost inflation, slow an already weakening U.S. economy. So the key points here. So JP Morgan Chase CEO Jamie Dimon said tariffs announced by President Donald Trump will likely boost prices on both domestic and imported goods, way down a U.S. economy that has already been slowing. Dimon addressed the tariff policy in his annual shareholder letter. He's the first CEO of a major Wall Street bank to publicly address Trump's sweeping tariff policy as global markets tumble. Markets still seem to be pricing assets with the assumption that we will continue to have a fairly soft landing, Diamond said. I am not so sure. So that's number one. Let's keep going here. The Fed's Kashkari says rising bond yields and a falling dollar show investors are moving on from the U.S. I love that. Moving on from the U.S. Where are they moving on to exactly? Last time I checked, while the amount of transactions done around the world in U.S. dollars has certainly decreased, the U.S. dollar is still the world reserve currency last time I checked. So where exactly are they moving? So Minneapolis Federal Reserve President Neil Kashkari said recent market trends show investors are moving away from the U.S. as the safest place to invest. Treasury yields are rising while the U.S. dollar has sagged against its global counterparts. The central bank officially said that is counter to what one might normally expect. So, again, I present to you the plan, ladies and gentlemen. The plan. Do you think that a weakening dollar might be part of the plan? I would say it is. Okay, and again, this is just the fear mongering. This is the pattern I'm trying to display to everybody here. So, all right, let's take a look here. Here's Goldman Sachs. This stupid website. Gotta love this website. So I think the title was Goldman Sachs cuts GDP estimate, raises risk of recession amid tariff rout. So Goldman Sachs analysts cut their projections for GDP growth. It said a recession could be more likely because of Donald Trump's tariffs. They now put a 45% chance on a recession in the next 12 months, with its likelihood set to rise if most or all of the tariffs stay in place. The analysts said they have seen financial conditions worsen, foreign consumers boycott American goods, and a spike in policy uncertainty. So, and I just want to see if they had a comment in here. So Goldman analysts lowered their GDP growth forecast to 0.5% for the fourth quarter and 1.3% for 2025, down from 1% and 1.5% respectively. The analysts said they now expect the Federal Reserve to make 3 consecutive quarter-point rate cuts starting in June, a month earlier than they previously expected cuts to start. In a recession, they expect about 2 points in total cuts over the next year. Now, that's great that they expect that. I would pose you a question. Has Jeremy Powell said anything about that? Has he issued any forward guidance? One of their favorite tools over there at the Fed. Have they done anything in respect to that? No, I would say no. I said last week, Jeremy Powell has taken his ball and he's gone home. Okay. He's wiped his hands. He's not doing anything. He's not doing anything to help anybody. Again, maybe we should bring Janet Yellen back. Maybe we should bring Grandma Janet back. He needs his bestie. Maybe we should bring it. She's like a comfort blanket. Hey, maybe we could bring Helicopter Ben Bernanke back at the same time. We could reunite the three amigos, get them back in there, rolling together hard over there at the Fed, like their glory days of the last 16 years. Nobody wrecked an economy like the three amigos wrecked an economy. I digress. But one of the funny things, and again, I love the guys at Zero Hedge because they did an excellent job of pointing it out. I'm trying to think who it was earlier this week. I don't think it was Goldman, but one of the major Wall Street companies, literally in the same, hours apart, the first report came out and they were like, it's a recession. Everything's blowing up. Everything's going to smoke. It's all done. It's all done. And then literally Trump goes, okay, 90-day pause on everything. The market roars back. And then literally like 3 hours later, they're like, okay, it's not so bad. It's all right. Maybe we jumped the gun a little bit. It's almost comical. It was almost comical to watch. Okay, and then BlackRock's Larry Fink, of course, today, he was on the CNBC this morning, and he says that the U.S. is very close to a recession and maybe in one now. So fears of an economic slowdown have risen sharply since President Donald Trump unveiled widespread tariffs last week, sparking a sell-off in the stock market. I think you're going to see across the board just a slowdown until there's more certainty. And we now have a 90-day pause on the reciprocal tariffs. That means longer, more elevated uncertainty. Exactly what I said earlier. Despite his concerns about the economy, the BlackRock CEO said he did not think the US was in a financial crisis and that megatrends in the economy like artificial intelligence would persist. So, again, maybe we do go into a recession here. Maybe we do. But I would also, like I've been saying, this is also part of the plan. This is why you're seeing oil prices come down. You're seeing egg prices come down. You're seeing inflation come down. This is all part of the plan. You're going to have a softening or a weakening in the overall economy on a numbers basis. It may very well drive us into a recession, but what you have to understand is that that is also going to help us in other ways. And hopefully, what is going to happen is that interest rates are going to come down as this settles in over the next 6-7 months, and it's going to take at least 6-7 months as this settles in. Hopefully the interest rates will begin to come down, but we are going to see some whipsawing. We're going to have weeks like we had this week where the market is up and down. It's one day it sells off 3,000 points, the next day it's up 3,000 points. We're going to see a lot of that over the coming months. We're going to see weeks where the 10-year U.S. Treasury, it spiked 50 basis points this week. We're going to see that. We're going to have weeks, I'm sure, where it's probably going to drop 50 basis points, and then it'll spike back up, and then it'll drop again. That's just going to be the ebb and flow of this for a little while until things settle down. But this would be one of those very rare occasions when I actually root for a softening in the economy. I root for a softening of the labor market because this is going to help us. If it will bring inflation down, and it will bring prices on a number of items down, if it brings the cost of energy down, that is all going to help in making things affordable for people again. That's what we want. And now, certainly, we don't want people to lose jobs, but affordability is a major issue at the moment. We need people, especially, what they call the bottom 50%. The bottom 50% are struggling, hardcore struggling. Scott Bessent, he said something very profound in an interview that he did last week, and that was you have this dichotomy in the U.S. economy where you have a certain group taking more trips to Europe than has ever been taken by Americans in the history of the country. And then you have another group that are basically made more trips to the food pantry than perhaps since the Great Depression. That is one incredible dichotomy right there. And so basically the top 1% or the top 10% are living better than ever, but the bottom 50% are they ain't doing so hot. They aren't doing so hot. And so we need the prices on this stuff to come down to make life more affordable for that bottom 50%. Like, we have to have that. And then we need the interest rates to come down to stimulate the real estate market and to also make it cheaper to refinance our national debt. That would be tremendously helpful in a lot of areas. Let's look at real estate for a second here. Say the tariffs do drive an increase in costs on a lot of the products that the builders need to build houses. Okay, well, one way you could offset that is with lower interest rates. If interest rates were to drop from, say, like they spiked up to 7%, as we just saw here a little earlier, if those rates come back down to, say, 5% or maybe the high fours, you're going to see a dramatic jump in real estate activity. Those lower interest rates will offset some of the increase in prices for materials. That will happen. So again, if energy costs come down, a lot of your utilities become less expensive on a house. Again, helps to make housing more affordable. So again, we'll see what happens here. But I wanted to show you guys these articles so you begin to see the narrative, the theme here. J.P. Morgan, recession, inflation, we're going to get this boost, that. And then Kashkari, everybody's running, the dollar's weakening, all these investors, they're dumping the U.S., they're running away. Goldman Sachs, we're cutting the GDP, we're risk of inflation, risk of recession. BlackRock's everything. We may already be in a recession right now. So you begin to see this narrative of total panic. Nobody looking at the bigger picture. Nobody looking at how this may play out in the months and weeks to come, and how we could actually get a lot of positives out of this, out of a softened economy, or out of economy that goes into a recession. So so again, I maintain that we all just have to be cool. We have to let this process play out for a little bit, and we have to see what happens. But do not, if you see the economy, like I said, if you see the stock market go up and down a few thousand points in a day, don't freak out. It's like I said earlier, the stock market it's at 40,000 plus points now. 1,000 points up or down either way, not going to make a huge difference. So, okay, now let's keep going here with a couple other stories here. So this was kind of interesting this week. So the IRS chief quits after immigration data sharing deal. So the acting head of the Internal Revenue Service plans to resign, the Treasury Department said on Tuesday, a move that comes after the agency struck a controversial deal to share tax data on undocumented immigrants with federal agents. Commissioner Melanie Krause will become the tax collecting agency's third leader to exit since the start of the year, a chaotic period marked by the firing of thousands of its employees mandated by Elon Musk's Doge. Her departure also comes amid the busiest time of year for the IRS, with the filing deadline for most individual tax returns falling on April 15th. Yeah. Don't really care. Like, yeah, don't let the door hit you on the way out. Yeah, see you later. I'm sure we could find any number of good people to run the IRS. I don't think that's going to be a problem. Yeah. So yeah, you want to throw a temper tantrum and because they want some data on illegal immigrants. Okay. All right. See ya. Okay. Some other headlines here. So the Wharton Business School takes sole possession of top spot on the U.S. News MBA rankings. So again, the Wharton School at the University of Pennsylvania sits alone atop the 2025 U.S. News and World Report Graduate Business School rankings after sharing the top spot with Stanford University's Graduate School of Business last year. While Penn led the way among all full-time MBA programs, another Philadelphia school jumped into the top 100, which was LaSalle University. But let's go down here. So after Wharton, Stanford's Business School tied for second with Northwestern University's Kellogg School of Management, the Booth School of Business at the University of Chicago, and the Sloan School of Management at MIT rounded out the top five in that order. So tuition and fees total close to $90,000 per year at Wharton, and 20% of applicants were admitted in the school's most recent graduate admissions cycle, with 866 enrollees. The 140-year-old Wharton is the oldest business school in the U.S. U.S. News further ranked schools by specialty, and Penn had the top programs in the nation for finance, real estate, and an executive MBA, which comes with an over $230,000 price tag. Yes, that is a big price tag. Now, remember, if you go to Wharton, it's a 2-year program and it's full-time. It's a full-time program. So you're not working, or at least you're not working a full-time job while you're going through that program. You're basically committing to going through the program for 2 years. And like I said, I've seen other estimates that estimated the program at a minimum of basically 250,000 for 2 years. So it's a steep bill, but hopefully, if you get in there, hopefully you will, make a whole lot of contacts, and it can boost you up. So, but anyway. The CRE industry, commercial real estate industry, braces for impact as trade war raises construction costs and economic uncertainty. So again, this is just an article talking about how, hey, the tariffs could, really increase the cost of goods for the construction industry, particularly anybody in commercial real estate, even in residential real estate for that matter. And how it's just the tariffs are creating some turmoil within the industry, as I would imagine it would for the time being. Couple of interesting articles here, basically about the labor market. So this is the first one here. This is called "The Digital Graveyard is Breaking the Hiring Process and Forcing Changes." So more than half of Americans looking for jobs have lost faith in the hiring process amid a deluge of ghost postings, scams, and broken application systems. Now, I actually have done some episodes on this, like ghost postings and everything in the past. So if you want to go check them out, I've definitely got them up there. According to an extensive survey from hiring platform Checker, 58% of Americans looking for jobs said securing an interview or response through traditional job boards feels nearly impossible. while 66% reported applying for jobs that appeared to be open but were later found to be inactive or so-called ghost postings. A majority of respondents, 61%, believe that landing a real in-person interview without a personal connection has become nearly impossible. The job search process in America has become increasingly frustrated, opaque, and mentally taxing for applicants across all generations, the report stated. The survey also found that 67% of respondents believe companies are not being honest about their true hiring intentions. 83% said ghost hiring causes an extreme lack of trust between applicant and employer, and only 22% said the job search process is transparent and fair in today's marketplace. Now, in the episode that I did on ghost posting, so right now you've got about, 7.5 million job openings roughly right now in America. So it was basically estimated that half of those job openings were basically ghost postings, or just weren't real, or the company just wasn't really serious about actually hiring a person. So that is extremely disconcerting, that literally almost half of the potential job openings out there could be ghost postings, or just, basically not real job postings. I think AI plays a tremendous role in this, because basically, all of these, especially if you're applying to a big company, I mean, all of the job applications are just getting scanned by the AI. You're sending it in, and it's basically like sending it into a black hole. And unless you hit the 3 or 4 keywords that particular company is looking for on your resume, it's gone. It's gone. You could have the greatest resume in the world. If you missed a couple of their keywords, it's out. You're out. And I think that is what's causing people tremendous consternation out there in the market right now. So I think this so far has turned into one of those rare instances where AI is backfiring in a real way on people. It is basically proving to not be helpful. And it basically says down here, job postings across the internet seem to be using similar language to dissuade workers from using AI tools, whether it's a marketing and communication specialist at a financial services firm, a digital marketing position at a health technology company, or even an acting coach. The use of AI by job applicants has flooded employers with job applicants, increasing the amount of time it takes to sift through them. So now in this instance, they're saying that AI is coming from the job applicant, which could, again, very well be true as well, but it's also being used big time by the employer also. So, and then let's take a look at this other article here. So the white collar recession is gaining buzz, but the reality is more complicated. So white collar workers may be feeling the squeeze of sagging labor market, economic turmoil, and high profile layoffs, but economists have some relatively good news for those employees. It's not a white collar recession. It's just professional anxiety. Oh, okay. The term white collar recession has gained traction in recent months as a number of companies, Amazon among them, have targeted middle managers for layoffs, and the Trump administration has moved to cut consulting contracts and tens of thousands of federal jobs. The rise of generative artificial intelligence only further threatens knowledge workers who once were thought to be relatively safe from automation. Altogether, it can make the job market seem painful for white-collar workers, said Noah Yassif, economist at the American Staffing Association. The data at hand so far still shows white-collar work at a solid bet, though. But I would maintain, as we have looked through the job reports in recent months, that the white-collar jobs were just getting, all the jobs being created were basically part-time jobs. And all of the really good, like white-collar, six-figure plus paying jobs were going negative. And that's been the trend for most of the last 2 years. So we have seen that. So this idea that the kind of white-collar recession is not real, I think it is very real. And I think it's out there. So, all right, I just want to look at this real quick. So ex-OpenAI staffers support Elon Musk's case against startups' efforts to transform into a for-profit company. Now, I might have just said earlier that I'm doing this episode in about a week or so on Sam Altman getting fired from OpenAI. Might want to watch that episode to get a little bit more detail on this, just saying. Okay, so I think with that, I'm going to wrap up. So I'm going to do as I have been doing for weeks now with the wrap up. I do our weekly story, and then I give our quote of the week. So our weekly story. So if anybody who's been watching for the last few weeks know, I have basically started out. I covered the Panic in 1907. We did Black Thursday in 1929. We did Black Monday 1929. Then we did Black Tuesday 1929. And now we're just covering in general the stock market crash of 1929. So the stock market crash of 1929 began on October 24th. While it is remembered for the panic selling in the first week, the largest falls occurred in the following 2 years as the Great Depression emerged. In fact, the Dow Jones Industrial Average did not bottom out until July 8th, 1932, by which time it had fallen 89% from its September 1929 peak. It fell 89%, man, making it the biggest bear market in Wall Street's history. The Dow Jones did not return to its 1929 high until November 23rd of 1954. So it took almost 25 years to return to its peak after it crashed. This fourth week of October 1929, panicked investors sent the Dow plunging 11% in heavy trading in what would become known as Black Thursday, which we covered last week. The stock market crash of 1929 was a historic stock market crash and is often cited as one of the catalysts of the Great Depression. One of the events leading to the crash was the introduction of new regulations concerning public utility holding companies. By 1929, thousands of electricity companies were consolidated into holding companies that were owned by other holding companies, which controlled about 2/3 of the American industry. When the news came that the public utility holding companies would be regulated, it triggered a massive sell-off as investors who had bought stocks on margin became forced sellers. In the wake of the crash, Congress passed an array of important federal regulations aimed at stabilizing markets, including the Glass-Steagall Act of 1933, the Securities and Exchange Act of 1934, and the Public Utility Holding Companies Act of 1935. 3 incredibly important bills of legislations that dramatically influenced events throughout the next 80 years. All came out of that, basically 1933, 1934, 1935, massive legislation that was passed and affected us for a long, long time. And I will cover at some point the Glass-Steagall Act, because that is a huge act. For people that don't know, Glass-Steagall was repealed in 1999. And I believe that it was one of the major seeds that ultimately planted the Great Recession that ultimately came and kicked off in 2007 and roiled through 2008 and landed in 2009. Now, one interesting thing that I would point out is that it took 4 years when the stock market crash in 1929 occurred. As they said, it took 4 years to hit the bottom, which was 89%. If everybody remembers, in the Great Recession of 07, 08, 09, we did not hit, it kicked off in 2007. We did not hit the bottom until March of 2009, when the Dow Jones cratered out at about 6,400 points. And I believe the market was down, if I had to take a guess off the top of my head, I'd say it's probably 70%, 60 something percent at that point. So those days, I remember those days very vividly. They were not fun days at all. Okay, so what is my quote of the week here? Let's go over here. So, and I thought this was a good quote for this week, given the volatility, things that we saw in the market, things that happened. So, inaction breeds doubt and fear. Action breeds confidence and courage. If you want to conquer fear, do not sit home and think about it. Go out and get busy. And that was from Dale Carnegie. So I thought it was a good quote for this week. So if you want to conquer fear, get out and get busy. Do something about it. Don't just sit down and panic. So good message for the week. But with that, I will wrap up by saying, if you like what you're seeing here with the live stream, please make sure to like, share, and subscribe, as that really helps the channel. I'm really trying to make a push at getting 1,000 subscribers. So if you can spread the good word about the channel, I would greatly appreciate it. Please make sure to leave your comments, as I always love getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. You can find us out there. Be sure to go check out thebankernextdoor.com. Got a lot of good stuff there up on the website. Go check that out whenever you have a minute. And remember to check out some of the other content on the channel, as that always helps. But with that being said, I wish everybody an awesome weekend. Have a great time out there. Happy Easter for everybody out there. I hope everyone has a great and safe holiday over the next week. And like I said, I'll be back here in 2 weeks. I'll see everybody soon. Take care, and thank you again for listening. See you guys.